Joining us live from the CME Group in Chicago is Larry Shover, Chief Investment Officer at SFG Alternatives. Larry, perhaps if we could start with you, what are you seeing there in terms of this rally underway on the US stock market there? Is there the sense that the S&P 500, it had that 10% fall, the correction that everyone was waiting for, and now bouncing back there, the buyers really moving back in?
Yeah, Bridie, you put it nicely. I mean, it's amazing to think that just a week ago we were 6% lower, trading at 1820 in the SPX cash, and everybody thought 1800 was inevitable. Now all of a sudden it's taken a 180-degree turn. We rally over 6%, and now everybody's saying, "Oh, we have to get above 1950. It's prerogative. It's just going to have to happen." I mean, the reasons for the market going down and going up, I mean, they're endless. But the fact is, it's like, in my mind, it's like 20% fundamental, 80% psychological. And right now, I've never said this before, but the pain trade is moving in both directions.
Just on what we've been seeing, Mark, in markets, I mean, too, also, of course, we've had that big rally in bond prices, but, you know, just sort of reversing, obviously, now with 30-year Treasuries just seeing the yield hitting session highs, extending the rise near 3% in late US trade. So outlook for bond markets then right now?
It seems to be, it's very hard to suggest to clients when they bought it at 186 that was a great trade, but it's fair to say that there's a lot of support in the bond market for any sell-off. So I think there's a lot of money in the sidelines saying, well, can we find some value? I believe that the way the Fed's approaching the bond market at the moment, it seems to be very dovish. So I think there's a lot of clients who are prepared to buy on the event that there's a sell-off. So it's hard to see much of a sell-off taking place. Larry's right. It's a very hard market to pick at the moment. A lot of people are hurting both ways. But the thing that seems obvious is that no one's prepared to get short the bond market. No one's prepared to actually try and take a position and drive rates up. Now the timing won't be good for the next quarter. I think it'll have to go into 2015 before people start to get short.
Larry, just on, I guess, you know, some of the big issues, corporate earnings there seem to be a real focus, as is Europe, and it seems that the sort of bullish view on Europe is being taken at the moment, this sense of, you know, more stimulus coming, perhaps even sanctions eventually being eased back in the midterm because of, you know, perhaps this deal being reached between Ukraine and Russia.
Yeah, exactly. Well, look at the U.S. market. I mean, earnings season right now, you take out IBM, take out Intel, some of the good and the bad, and overall we're still seeing double-digit earnings growth year on year. That's a positive thing. With Europe, it's a different story. I mean, it's a good story, too, that, you know, the corporate bond buying program has been applauded by the market. It's going to be very intricate, a 3-year program from what we're thinking or seeing. But their multiples are, especially in countries like France, are a lot less because we're not seeing the earnings growth or the economic growth that we're seeing in the U.S. So I still maintain a standoffish approach to European equities, letting somebody else have the first 5 to 10% appreciation and hoping I'm wrong.
Larry, it's Mark Todd here from the NAB. I've been travelling for the last couple of days, and I was curious about the idea that we've seen earnings growth in the States. What's happening on the revenue front? Are we seeing that as well? Growth in revenues?
Yeah, yeah, no, Mark, that's a good question. And yeah, we have seen revenue growth, not as consistent and not as large as we saw in the second quarter, but it's still growing. Top line growth is there as well. We're still seeing double-digit earnings, I mean, in aggregate, and we know that we're coming up to the apex of the season. The bottom line is, from my point of view, if you take out, you know, the semis, which is a big industry, obviously, and some of the good and some of the bad, and just look at the mean, earnings growth is still there in the U.S.
That's what you need to see. I think that what's the confidence feel like on the floor there at the moment? Are people starting to feel a little bit more confident seeing this sort of numbers and thinking they can separate themselves from Europe, or does Europe still look like it's an anchor around everyone's legs?
Yeah, that's a great question. Right now, it seems like Europe continues to be a drag anchor to the traders here on the floor. It's very reactionary. It's very skittish, volatile. And, you know, you keep in mind, I mean, you saw what happened last Wednesday in the Treasury markets, in the stock market. I mean, a lot of people just got extremely, they got hurt badly very quickly. And so right now, you know, the liquidity is just not there. People are applauding the rally in the stock market, but you know, people just aren't climbing on board like they were vice versa last week.
And Larry, just quickly, I mean, you're pointing out just a couple of key events, obviously, to watch out for, including the flash PMIs across the globe, that's going to be key then for the outlook?
Yeah, absolutely. I mean, tomorrow we get CPI, and we remember August print was disinflationary per se, so people will look at that. But yeah, PMIs are very important. All eyes will be on that. And you know, the consensus is looking for China to slip just under 50, U.S. to be flat at 57.5. But obviously, all eyes will be on Europe and trying to figure out how to decipher the numbers we see there.